Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been
talking
about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome to The Big Picture. My name is Joe Cruey at Paradigm, in the weeds around everything crypto vol markets. Joined here today by my colleague David Brickell, as well as Gordon Grant, head of derivatives at Genesis, who is becoming quite the regular on our channel. Before we begin, please hit that like and subscribe button. It really helps us as we continue to build this channel to become the go-to source for insights around crypto derivatives. Gordon, man, really excited to have you on today.
Thanks,
I think it's it's going to be a big show. You know, despite the fact that the markets have been relatively quiet, I do feel like, you know, there's a good amount to talk about here. And, you know, I guess I'll just start, like, the amount of conversations that I've had over the past 2 to 3 weeks of dealers just being like, I'm bleeding long vol, you know, especially in Ethereum. It's pretty crazy, you know, the sort of like one-way conversations I've been having around this. And, you know, we know that this ETH overrider that we've mentioned many times before was active again last week. You know, 120K of Dece Vega was being sold during this roll. And, you know, to be honest, guys, I mean, there was like a part of me that didn't want to talk about this override again. But, you know, like but at the same time, it doesn't like feel to me like we're really beating a dead horse here, considering this program. It feels like it's only getting bigger, and it's just having such a significant impact on the market. You know, and interestingly, so if you just look at the prints here, it also seems like this counterparty, you know, also bought the Dece 3000 calls last Tuesday against these overrides, you know, potentially as a way to, you know, reduce margin burden on a rally. And so we kind of have all the big trades there on the screen. But like, Gordon, I guess just jump right in. Like, kind of seems like there's a pretty significant, you know, supply and demand imbalance in the ETH vol market. I'm just curious to hear your thoughts on that.
Yeah, you know, was talking to some other folks in the industry about this recently, and even folks that have kind of been more kind of DeFi centered for a period of time, and sort of understanding, well, wow, what's up with ETH vol, and why is the spread all of a sudden now flat to negative versus Bitcoin, and what's going on there. It's important to take a look at the history of ETH options and the volumes that they have historically seen relative to Bitcoin. Ethereum, the Ether options market, always smaller than Bitcoin. As you guys know, even some of the top market makers don't really spend as much time pricing or quoting Ether. Historically, there have just been the pure Bitcoin guys. There have been many, shops that have traded only Bitcoin options. So Ether options market, as a sort of legitimate, serious institutional grade concern, has only come into its own, I would say, probably from my perspective, within the last 2 years, right? 2021 was when the Ether options market really started to scale, and we saw takers that were doing chunky volumes that would be the equivalent of Bitcoin, right? Whereas if you had a taker who was doing, 1,000 units of Bitcoin options, you would start to see guys that were doing, 20,000 plus units of, let's say, ETH calls when you had ETH BTC closer to like 0.08. And so now, right, when we start to see these overwrites, we're seeing the same effect that we saw in the great vol expansions of EOR and ETH, right? And those were the Raoul Pal, kind of wing call convexity play skyrocket moves where ETH vols went from 80 to 120 in a short period of time. We've seen that exact kind of mirror image now, where ETH vols have just gone from, literally 80 to 40 in a relatively compact span of time. And that's a reflection of this market's inability to sustain or warehouse the kind of risk that's being granted, right? Where does this Vega find a home? That's really the question. There's no cross-asset vol product for ETH. There's no offsetting BITO, Coinbase, or MSTR, or Riot or Mara kind of easy proxy for people to take a look at. Of course, there is a high degree of beta and correlation between ETH and Bitcoin, but really at the end of the day, it's just still to a certain extent idiosyncratic risk that people have to take down and digest. And ever since we saw this overriding flow pick up at the end of last year and gradually accelerate, it's always been my God, they're doing more now at this level, right? And of course, to an overwriter, it's a different mentality than a vol trader has. There's never really a bad level of vol to sell as an overwriter because your program is, I just need to keep taking in premium. Options that I don't sell is an opportunity that I lose. And we've seen this, right? The first sales of the June 1800 calls occurred at a time where the taker could have sold let's say April or May vols at the time, or just ahead of the Chapella, upgrade, could have earned, I think it was a 3 vol premium or maybe 5 for selling the shorter dated strikes. But instead they choose to sell the longer dated, lower IV strike that was less liquid, give up more of a concession, both in IV and spread, just to get those premiums in the door. And that was, at that time, let's say, again, 100K kind of a Vega. This D sale that's happening now, right down into the mid 40s, it's yet more of the same thought process, which is to say, I just want to keep extending this program out because it's working. I believe it will continue to work. And there's no reason for me to wait to hope for better IVs because they don't think about it in Vega terms. They just think about it as premium in the door today, I decay it to zero over time. And if there's a delta view that I have that overlays with this, well, then I really need to take advantage of it. And, ETH is kind of held in well, right? It's up here at, 1,900 odd bucks when they were doing these overwrites. It's had a decent bounce, and not surprisingly, the gamma in the market from those June 1800 strikes is starting to have that magnetic effect. If you're a taker who's running this program, you're just saying, you know what, I don't care about the vol. And I think that that's very important, right? And it's very important to understand that you kind of have this unstoppable force, and dealer balance sheets are not the immovable object that sometimes people think that they are, nor are even other taker balance sheets, right? We don't have big spec hedge funds out there saying, hey, you know what, I'll take this all down at 45 vol because it's not an S&P index volatility that you really can see a broad interest in. It's Ether vol, and especially for December. So that's a long duration in terms of venue risk versus whatever exchange you choose to put those on, notwithstanding, right, the sterling reputation that Deribit has within our industry. It's contains a number of things that are also unhedgeable as well, right? You take down that risk, and then you've got to hedge out your spot D spaces. Good luck trying to do 30, 40, 50 bucks of that stuff. So it really comes with the territory that we've continued to see this compression. I think it's been interesting to note that there's been very little in the way of flow suggesting that the taker wants to take this off. Maybe a little bit of a tendency, right? We've seen nascent interest to cover some June wingier calls just to spread against this. And it's not even clear that it's necessarily this taker. But yeah, really, I kind of think of this as unstoppable force, and there's no immovable object at this point, right down here, even at 45 vol. No one's got the balance sheet or the cojones to be able to stand up to this guy.
Right. Yeah. No, I think that's totally right. But also, outside of just the inability to kind of warehouse this, I do think the timing of when we're starting to really see, this increasing narrative of the significant supply demand imbalance in the ETH vol market, I think Chapella is a big reason for that, right? So since the Shanghai fork, you now have this increased withdrawal flexibility, and ETH has seen a significant increase in the percentage of staked ETH, which is now 18.75% of total supply to capture this roughly 6% APY from staking with a validator. So just looking at these charts, ETH staking has seen significant net inflows since the Shanghai fork. I remember all the FUD that we were hearing, once that withdrawal flexibility was allowed, if we were going to see a lot of people rushing to the exit. And, we really haven't seen that. And on a cumulative basis, the amount of Ethereum staked and the amount of validators has just gone parabolic, right? So my opinion as well is like the inability to warehouse this stuff is ETH is increasingly becoming this yield asset, which I think is increasing the marginal propensity to sell vol against one staked ETH. and perhaps explaining why, the ETH vol supply that we've seen on Paradigm, whether it's through this program or other users, or, David's pipeline of clients around ETH overwriters that, are continually looking to come into this market, has been ticking up. So you have this withdrawal flexibility that I think is increasing ETH's propensity, takers' propensity to sell vol. And, additionally, I mean, if you just look at the ETH forward prices on Paradigm, that's something that doesn't really make sense to me. I mean, it's effectively, a 6% dividend, and the ETH forwards are trading at a premium to spot. And then additionally, you have this sort of range-bound market that's kind of operating this sort of Lindy effect. It kind of feels like the longer we stay here, the more likely we are going to stay here, which just invites more overwriters into this market. And, you kind of just get this self-fulfilling prophecy, right? So ETH at the monies are trading flat to BTC across most of the curve. I think, ETH in December last week was under BTC. And to your point on the demand side, Gordon, right? Like, it does feel that the ETH vol market is pretty devoid of natural demand, except for, the occasional tactical call buyer, and leaning into, my past TradFi experiences, like, for example, in equity derivatives, you always had this sort of natural demand, whether that was, from some sort of hedging program or, or the structured product landscape. In equity derivatives, you'd have insurance variable annuity issuers who needed to hedge their optionality, baked into their insurance offerings. And in crypto vol, the natural demand just doesn't really seem there. And, combined with the fact that, you just have low realized, and, it's just causing this bleed lower and continued pain. I think that's also a big part of it.
Yeah, definitely. And there is that vortex effect or Lindy effect, as you say. And the closer we get to these strikes, the June case is somewhat interesting because we typically haven't seen a pin at an overwriter strike throughout the life of this program. This is the first time that we are seeing the market creeping up on a quarterly expiry with the bulk of that original OI still out there, right? June 1800 OI has come down from when it was well over 100,000 units, but it's still 92,000 units of the calls, right? And it's about 40 some thousand units of the put. So there's still a significant chunk out there, and what's there to pull us out of this vortex? It's very hard, right? I mean, that degree of gamma for the ETH market. People are right now getting excited about this Celsius, or I guess it's now Fahrenheit on behalf of Celsius, or vice versa, making a significant move to lock 700 million of value in staked ETH. That's a pretty good chunk, but 140 odd thousand units of ETH with one strike coming up for June. This is an entirely different proposition, right? I mean, you're talking hundreds of millions of dollars just of risk at one particular point. And as you say, when you take the whole market in its entirety, you say, okay, ETH, couple $100 billion asset, you've got close to $1 billion, let's say, being staked or unstaked or restaked, or rewards associated with that being moved, and how much gets sold or bought over a 24-hour period. Okay, and that can influence the market. But when you talk options are this market where you have this kind of time compartmentalization that happens. One in terms of Vega bucketing, right, and the other in terms of this gamma effect. December Vega and ETH is not really like any other Vega, right? It's not particularly fungible even for SEP at this point. March is too illiquid. So you have these effects where, just as with the June strikes, stuff kind of trades in its own universe, and it can have these perverse effects that you wouldn't really expect. So we don't even know what's going to happen with this degree of OI at one strike. I mean, this is a big number on a quarterly expiry here. We could see ETH gradually just get marched down to 1,800 and die. And I think some people...
it's going to go negative.
Right, yeah, exactly. That's right. Where your transaction costs of dynamically hedging your gamma are more than the actual realized value.
Imaginary number.
Yeah, that's it, right? And it's not a surprise here that we're starting to see a relatively steep smile, to the put side around this, and we're starting to see calls really flatten out, right? Where we've got, maybe just a couple of balls of wing premium for out of the money calls, and we've developed this kind of sort of tilted Jace type of smirk on the ETH smile, because local vol, no one believes this can perform.
Yeah, I mean, I was looking at the stat this morning. I was like, how many of the June 1800 calls have been sold on Paradigm in the last 6 to 8 weeks? And the number was like fucking 100,000.
Yep.
Right. And it's just all taker natural selling flow. Coming from dealers putting this stuff down. Right?
Yep.
Yes.
Yeah. Immediately gets sold.
Gordon, what happens? Obviously, the idea that you've got this open interest all convalescing around this 1800 strike, kind of understand how that becomes a magnet, and we kind of get pinned around there. Once we get the expiry done, what happens then? Because there's always a lot of a lot of hype around these big expiries, and particularly when they're all centered around a particular strike, and then the expiry kind of comes and goes, and then we just move on to the next thing. What's your view around that? What happens as soon as that 1800 expiry is gone in June? Then what?
Yeah, it's quite game theoretic. I find when I look at a market like ETH, especially, we have seen the tendency after major quarterlies for vols to go lower. Based on the premise that, well, folks were short, they had to have collateral tied up, the options expire, they have free collateral, and the first thing people want to do is kind of reload on vol shorts. But we haven't, as I said, seen an expiry where it's the dealers who are sitting long all this risk. And we've got the taker who, has effectively continued to extend the sales program based on the fact that we saw extension preemptively into SEP maybe 2 to 3 months ago, and then we've seen a new extension into December. I kind of look at it two ways. One, if this taker wants to continue the program, they've got a bunch of free margin all of a sudden that they could just go and ape right into March of next year and just hammer this thing, right? All the way down to a completely flat curve at, I don't know, 35 or 40. The other is that the market is out of this gamma vortex at 1800, and it doesn't have a natural supplier of ETH gamma at 35%. There's nobody who wants to sell gamma down at this level as a VRP trade. It just feels disgusting, right, to get paid for vol and ETH at these levels, because we all know what it can do. I mean, it's had $100 days even recently, which is a 5+% move at these levels. So there could also be the effect where maybe the taker decides to have a pause, and market doesn't find a natural supplier of gamma at this level. It's really only September. And then all of a sudden you get a move, right? Because there's no longer that pin effect there. And then you sort of see the front end jack higher into that move, because you have to get to the price that clears, game theoretically, right? And if people knew this, they would say, okay, so I'll sell June, I'll buy July, I'll sell June, I'll buy August. And I think that there has been some of that kind of game theoretically smart calendar spread trading going on. You just don't want to buy SEP, right? Because everyone knows that SEP 1900s and 2000s are also a dog, and the same thing will happen to them. And those are really non-fungible risks. Like any other strike in SEP, it's not normal. You can't compare it. I don't mean normal in a statistical sense, but it's abnormal to think that the 1900 or 2000 is completely non-fungible for these other strikes. But for me, the key thing is, okay, so there's extension of the current program, smash the whole curve down, extend it out. But still, in that case, the market doesn't get back gamma, right? They don't get given gamma by this taker. And you've got to wait 3 months to really decay into a meaningful amount of gamma. Or, right, the taker does nothing, and the market has a move, and we see more of a pronounced effect. So my view would be to say we see a little bit of relief from this tremendous downward pressure at the front of the curve, and tend to see a little bit of normalization, probably see a little bit of a pickup in realized volatility. We know that ETH has had a few of these wild summer moves in the past for different reasons. The lift off the bottom in 2021 was pretty ferocious. The move in 2022 after the Three Arrows debacle and before the merge is it possible that there could be another bit of a squeezy, rip into July for ETH? Yeah, sure. And the market is also telling you, interestingly, it's not as worried about calls, which I find interesting, right? And that suggests also perhaps there's more taker flow that's driving skews in favor of puts in order to hedge some of this yield play, right? Because you don't mind having a high put skew when the asset itself is a good static yielder. And that's something you often see in emerging market currencies and other kinds of things. But the key for me is the only thing we're asking here is nothing fundamental about ETH, nothing about macro, nothing about monetary policy. We're all asking, what's the taker doing? And that tells us everything you need to know. One taker overwriting clips of 100,000 units of ETH is dominating this market. And I don't think we've really ever seen anything like this in crypto, right? We know that there are some overwrite programs at Bitcoin that are big, and there are takers that come in and whack out a few thousand units, but it's Bitcoin. The market can handle that. In ETH, we just haven't seen it, and it keeps going.
Yeah, and I think that's a good segue to kind of just talk about this interesting volume trend in, BTC versus ETH, since the start of the year, just like taking a step back here, right? In Q1, the big theme was this, resurgence in BTC upside interest, mostly, in this outright call format that, we've talked about extensively on other big picture episodes earlier this year. And, the volume picture has completely shifted since May. And, this chart shows that trend well. So this chart shows the 7-day moving average of the ratio of BTC to ETH volume, which is that blue line, as well as the BTC to ETH open interest, which is that orange line. So just looking at that blue volume line, it took off at the start of the year, indicating this much greater interest in, BTC optionality, which peaked at over 3-1 as we saw that BTC driven rally. And it kind of felt like every time we came on the big picture, we were talking about BTC outright calls, right? But since spot has stalled,
get those days back.
yeah, exactly. Right. Since spot has stalled out, that blue line has completely retraced, almost back to pre-rally levels. So in other words, in March, the BTC option volumes were 200% bigger than ETH, and now they're only 50% bigger than ETH, right? Like that's quite a big retracement there. And of course, the open interest line is going to follow a similar trend, but naturally is going to operate on a lag relative to the trend in the volume. And if you look at the culprit of that declining ratio in volume, it's BTC. ETH volumes have been largely flat, and that's been driven by, the big culprit out there, that overwrite roll activity. And, no surprise, and it's certainly no surprise that volumes across all crypto products are trending lower, and not just in options. It's happening in spot, it's happening in perps. So, it's notable, certainly, the ETH volumes are hanging in there, albeit the ETH volumes are certainly on a lower base, rather than, coming off the highs in an asset like BTC, right? So, it kind of does seem we're kind of moving, towards this ETH-centric derivative market, at least for the short term. But I guess Gordon and David, what's kind of the base case here? Do we see this sort of BTC volumes just sucking wind until we actually see a rally? And if we do see a rally, what is the driver of that? I mean, we have CPI and FOMC in the 13th and 14th.
Dave, if you want to take a crack at it first, I certainly have my thoughts as well.
Yeah, I mean, I guess, I'm still of the view that we lack in any kind of macro narrative, certainly as it applies to crypto at the moment. I think, again, we're in this, certainly from a macro side, we're in this kind of transition from that sharp Fed tightening cycle to now the end of that, and then transitioning towards the pause and the what will eventually be the cutting cycle. The issue we've got right now is that we can't fully embrace that. The data is still pretty resilient, at least it's mixed, I would say. So we can't fully embrace this pause that we can then start sort of knowing, okay, we've moved into this new regime. So there's still, just as we start to even price the cuts in, then we're back to pricing hikes again. So I think at the moment, without having a sort of real sort of macro narrative that's clear and gives us a clear direction on where we're going, and then we can start to play things around that. then I think, you end up just being faced with like these mechanical flows that just dominate everything. The other thing at the moment as well is I actually think, if you look at what's going on in NASDAQ and in stocks, we are seeing a good sort of bid and interest returns to the market. Now, yes, there's a little bit of AI hype around that driving, but also I think a market that's underpositioned and being sort of forced to chase. And crypto's just not sort of jumping in with that and playing catch up with that. I think actually for once crypto's been the grown up in the room a little bit and kind of is cognizant of this liquidity drain that we've potentially got coming post the debt ceiling lift. And I think everyone's kind of sort of waiting on sort of bated breath in terms of how that's going to play out. Now, there's offsets to it, right? We know, I think JP Morgan are talking about a $1 trillion liquidity drain. Now, how they rebuild the TGA an issue will be paramount in terms of how impactful that liquidity is. If it's all sort of mainly some T-bills and it starts to get funded essentially through the RRP coming out, then actually we might not have this big liquidity event that everyone's kind of holding back for. So I think it's going to be interesting over the next few weeks to see if that negative liquidity event doesn't happen in the way we're all fearful of, then all of a sudden you might see crypto look at what's going on in equities and think, right, yeah, we can join that party now. And then all of a sudden, it's like price breeds price and interest, and all of a sudden everyone's rushing back in and trying to put on top side and chasing, and then you get this virtuous circle where we're all kind of chasing higher and that higher spot, higher collateral, more leverage, and all that sort of move. So I just think we're waiting for the spark actually from the macro, or albeit something else to really get us there.
I think that's fair. Crypto certainly has been more staid in terms of moderating what appears to be kind of a euphoric, boost in equities that is somewhat lacking in deference to the liquidity withdrawal resulting from the bills issuance. It hasn't been falling out of bed for the reason that the same narrative that brought crypto off the bottom and caused that scorching 40% 14-day rally, and Bitcoin is still kind of here. Right? I think people are, who pay attention to the macro space and are listening to folks like Jim Grant's Interest Rate Observer, no relation whatsoever, and others. That's Mohammed El-Arian. He does wear a nice bow tie, though. I'll give him that. And El-Arian and other folks, right? They've said, hey, there are serious structural problems here. The UK and the EU continue to acknowledge that inflation is running hot. And there are geopolitical concerns. There are thoughts about de-dollarization as a secular trend. And so all that stuff potentially is keeping a floor under crypto. And there is this overall tech narrative and AI narrative right now. And that's probably potentially, as on a factor basis, working in crypto's favor. But market certainly hasn't lost its head. It hasn't conflated crypto with AI in any kind of wild way at a benchmark level. And so we're just sort of sitting here treading water. And there's definitely potential for, I would say, the market to kind of digest this liquidity. The interesting thing is, we've spoken about this before. We've already done a lot of the damage of removing liquidity from the crypto market by taking away these fiat on-ramps and off-ramps. This bills issuance won't hurt crypto prospectively in the way it would have in times past, because the mechanisms by which you would pull dollars out of liquidity, let's say, as an institution to go buy a bunch of bills that are getting issued, those linkages actually, they're just not there, right? In the way of, Genesis is not a precious metals dealer, for instance, that says, oh, hey, you know what? I don't want to hold gold as a tier one asset on my balance sheet like some precious metals dealers do. I actually need to step up and redeploy capital and buy a bunch of bills. And so let me take a couple $100 off the balance sheet out of gold, do some kind of, EFP, TWAP out of physical into futures, and I'll use that excess cash to go buy bills. That's just not a game crypto dealers are in, right? People are not being asked. They're not primary dealers. They're not folks that have a balance sheet that is substantively dependent on dollars in the way that traditional financial institutions are. So that's another kind of thought to me is what if we, because of what's happened with the banking system disconnect, this year. What if we, sort of jump the shark on that and find ourselves kind of looking around and saying, okay, so the bills issue has happened and crypto's not, 20% lower. Then does the market kind of say, well, I guess we can kind of get along now and move forward. That's an interesting proposition. And crypto to me feels less correlated than other times, right? We're not necessarily seeing that sympathetic same day relentless correlative influence of a tech-driven move, a NASDAQ-driven move for crypto. Some, detractors might argue that ETH at close to 2K, even with what's going on in the world, where we don't know whether it's a security or a commodity, and there's been some of this hawkish commentary from folks like Dan Berkowitz that have suggested that things can be both subject to CFTC and SEC regulation at the same time. Maybe the tech rally is keeping ETH up here, but I'm more of a view that crypto is just slowly getting, kind of untwisted, unplugged from the traditional financial system in the ways that we understand and know. And so, that could explain, what's in store for this asset class, perhaps over the next quarter to come, especially once we get past some of the more technical factors, like this huge amount of gamma that's sitting in the market. To answer your question, Joe, about, well, what do we think would bring volumes back into the crypto market, into the Bitcoin market in particular, I tend to view a renewed rally as being something of a sufficient condition for that. We've seen the gearing effect that volumes and prices and volatility and therefore options volumes and flows have on each other in this virtuous circle. With the degree of apathy that we're seeing now, which is not just a function of ball selling, but just sort of lacking a general catalyst, I tend to say that even if we were to drift lower down to 25,000, let's say in Bitcoin, it doesn't feel like a moment where we're going to see people grabbing personality because there's a trend break. There would need to be, I think, a macro list or something to the downside to really lead the way higher in a meaningful fashion for implied volatility and volumes. Otherwise, it's likely to be a spot up, vol up, volume.
Also, as well, I mean, I think to add to that, like when I think of certainly from the macro side of things right now, rates have repriced higher over the last sort of month or so. Dollars kind of moved higher over that time. So actually, you've had quite a negative dynamic that's formed against sort of Bitcoin and crypto. And I actually think it's quite interesting that we've not actually made more progress to the downside, which again tells me there's not a lot of leverage. It's also because of some of the banking issues, it's not as easy to get short now and short crypto. So you're kind of just left with the hodlers who are, they've ridden a huge move over the last sort of year or so, probably aren't going to be puking out that anytime soon. The only other kind of like negative flow dynamics you get from a spot point of view, I guess, would be, which we saw obviously post FTX, where you got false liquidations and bankruptcies and what have you. In the absence of that, it doesn't feel there's any kind of natural sellers or anyone trying to short this. There's not a huge amount of leverage in the system that could potentially get washed out. So actually, we're kind of working against quite a negative dynamic from macro with higher rates, higher dollar, and now this upcoming potential liquidity drain. Those things start to reverse. We had a weaker ISM earlier, and we've sort of priced, we're pretty much priced out June now. And I think we're almost just above 50-50 for a July hike. All of a sudden, you start seeing the rate dynamic come a lot lower again. If dollar starts to come off again, and the tailwinds start to pick up, then we're back into a regime which, Gordon, I completely agree with you. Price starts to go up, and price drives narrative, and all of a sudden people are trying to ape in, and we're in this positive spot vol correlation. Volumes are up, price is up, and the world seems a better place.
Yeah. And kind of just outside of macro narrative, let's talk more about, a medium-term crypto idiosyncratic one. And there's certainly a lot of hype, all over Twitter and my pundits around, on June 1st, Hong Kong greenlighting retail trading of some major crypto tokens like BTC and ETH. And I think Hashkey and OSL have approved applications, while OKX, Bybit, BitMEX, to name a few, still have applications that are waiting approval. But what I find the most interesting was on the day of the announcement was this news on this FD USD stablecoin. Announced on the same day of this regime change that a Hong Kong regulated stablecoin backed by high quality reserves issued by a trust company under Hong Kong's trust ordinance. Like, to me, like, that's even bigger news. Like, all other stablecoins in Hong Kong are currently illegal. So a Hong Kong regulated stablecoin announcing it's going to hit the market seems like a pretty big deal in terms of a medium term sort of, crypto tailwind. I do think it's going to be a slow burn, but I think, it is certainly a positive development for Chinese crypto adoption. And I think, looking at this FDUSD stablecoin and tracking that market cap, I think is going to be a pretty strong indicator to gauge this sense of Hong Kong retail impulse.
Yeah, definitely. I mean, the North Asia pivot in crypto has been one of the more meaningful trends of the last 6 months. It's happened at a time where the U.S. has become a far more unfriendly jurisdiction than in the recent past. And
we lost you there, Gordon, for a little bit. Can you repeat that? Yep.
Oh, apologies. Yeah, there was just an incoming call. I was just saying that, the North Asian pivot to crypto, significant, and this kind of, relatively innovative development occurring at a time that the U.S. is getting incrementally less friendly with crypto is one to watch, right? Undoubtedly. And we'll see to the extent that this is just more of a tactical pivot by the authorities there, or whether this is one that's going to lead to a more sustained, sticky participation by retail in that region in a way that, was previously the case, has not been the case in a while.
Cool. Well, I think we leave this one here. I mean, we certainly touched on a lot. I think 35 minutes is a good length for this one.